Oil at $200. The supply math nobody in media will run for you every single day. Financial media puts experts on television to talk about oil prices. They show you charts. They show you headlines. They argue about OPEC meetings and geopolitical tension and hurricane seasons in the Gulf of Mexico. But here is what none of them ever do. They never sit down and just run the math. Not the fancy Wall Street math. Not the kind that needs a PhD. I mean the simple, 6th grade arithmetic. That tells you exactly where oil is going and why the number at the end of that calculation should terrify you and excite you at the same time. Today, I'm doing what they refuse to do. I'm running the numbers live, right here, right now. And by the end of this video, you will understand why $200 oil is not a conspiracy theory. It is not a prediction. It is not even an opinion. It is math. Section 1. Why the media will never show you this before we get into the numbers. I need you to understand something important. The reason this math never gets run on television is not because journalists are stupid. It is not because analysts do not know how to use a calculator. It is because the people who pay for the commercials you watch between segments, the car companies, the airline companies, the petrochemical giants, none of them want you doing this math. Because when regular people understand where energy prices are actually going, they change their behavior. They change their investments. They start asking uncomfortable questions. And uncomfortable questions are bad for business. Here is the other reason. Oil is political. When oil is expensive, governments get blamed. When governments get blamed, they pressure media to soften the narrative, to talk about temporary spikes and market corrections and renewable transitions that are always just around the corner. So what you get is noise. Endless noise designed to keep you confused. Confused people do not prepare. Confused people do not profit. So let's cut through all of it right now and do something radical. Let's just look at the actual numbers. Section 2, the supply side math. Alright, let's start on the supply side because this is where the story begins. Right now, the world produces approximately 100 million barrels of oil per day. Write that number down, 100 million barrels. Every single day. Now, here's the first number the media glosses over. Every oil field in the world, every single one, naturally declines in output each year. The industry calls this the depletion rate. And for most conventional oil fields, that depletion rate runs between 6 and 10% annually. Let me translate that into plain language. If the world produces 100 million barrels today and we drill 0 new wells, 0 new investment, 0 new fields in just 10 years, production falls to somewhere between 35 and 50 million barrels per day. That is not a projection. That is geology. You cannot argue with geology. So the entire global oil industry is essentially running on a treadmill. Every single year, just to stay flat, the industry must find and develop enough new oil to replace 6 million barrels per day of natural decline. Now here is where it gets really interesting. New oil discoveries have been collapsing for decades. In the 1960s, the world was discovering more than 50 billion barrels of new oil every single year. By the 2010s, that number had dropped below 10 billion. In recent years, we have been finding less new oil than at any point in the last 70 years. 70 years. Think about what that means. We are consuming roughly 37 billion barrels of oil per year globally. We are finding fewer than 7 or 8 billion in new reserves. That is a deficit of nearly 30 billion barrels every single year. You cannot run a deficit like that forever. Now add one more layer to the supply equation. After years of ESG pressure, that stands for environmental social governance. Major oil companies have dramatically cut back on capital spending for new exploration. ExxonMobil, Shell, BP, all of them slashed their exploration budgets by 30, 40, sometimes 50% over the last decade. That investment does not come back overnight. Oil projects take 5 to 10 years from discovery to first production. The supply pipeline is not just slowing down. In many places, it is drying up. Supply math summary, on screen, production today. 1,000 barrels day. Natural decline rates, 6 to 10% per year. New discoveries, near 70-year lows. Annual supply deficit, approximately 30 billion barrels. That is the supply side. Now, let's look at demand. And this is where most people's brains break. Section 3. The demand side. Math, everyone in the Western world is told the same story. Electric vehicles are taking over. Renewables are replacing fossil fuels. Oil demand is going to peak and then collapse. Let me show you why that story is dangerously incomplete. Right now, there are approximately 8.1 billion people on this planet. The developed world, North America, Western Europe, Japan, Australia, represents roughly 1.2 billion of those people. The other 6.9 billion people, many of them are still in the early stages of industrialization. India alone has 1.4 billion people and per capita energy consumption that is less than 1/3 of the United States. Africa has 1.4 billion people and is building out basic energy infrastructure right now. Here is the mathematical reality. When a country industrializes, energy demand does not grow slowly, it explodes. China went from 5 million barrels per day in 2002 over 16 million barrels per day by the mid-2020s. That is more than a 3x increase in 25 years from a single country. Now, imagine that same curve, or even half that curve, playing out across India, across Southeast Asia, across Africa. The International Energy Agency, and this is not a fringe source, this is the establishment's own agency, has acknowledged that global oil demand is likely to remain elevated through at least 2030 and potentially well beyond. And what about electric vehicles? Let's actually run that math too. There are approximately 1.4 billion cars on the road globally right now. EV penetration as of the mid-2020s sits at roughly 3 to 4% of total vehicles in operation worldwide. Even if EV adoption accelerates dramatically, let's say 20% of new car sales are electric by 2030, the total share of EVs in the global fleet might reach 10 to 12% by that point. That means 88 to 90% of global vehicles are still running on petroleum. And cars are only 25% of global oil demand. The rest goes to aviation, shipping, petrochemicals, agriculture, plastics, heating. None of those have a credible electric alternative at scale right now. Demand is not collapsing. Demand is growing. Demand math summary on screen. Global population 81 billion. Most still industrializing India plus Africa. Energy demand. Explosive growth trajectory. EVs as share of global fleet by 2030. Approximately 10 to 12% oil still powers. Aviation, shipping, agriculture, chemicals. Section 4. The dollar debasement multiplier. Now I want to add a third layer to this equation that almost nobody talks about. And when you add this layer, the $200 number does not just seem possible. It seems almost conservative. Let's talk about the dollar. In 1971, when the U.S. came off the gold standard, a barrel of oil cost roughly $3.50. Today it trades around $75 to $90, depending on the week. But here's the question nobody asks. How much of that price increase is oil actually becoming more expensive? And how much is simply the dollar becoming worth less? When you adjust for real purchasing power and monetary inflation since 1971, the $3.50 barrel of oil, in real terms, would need to be priced at somewhere between $60 and $80. Today, just to equal the same real value, which means right now, in real historical terms, oil is not even expensive. It is close to fairly valued or even cheap. Now, what happens if the dollar loses another 30 or 40 or 50% of its purchasing power over the next 10 to 15 years? This is not a radical idea. The U.S. money supply has more than doubled since 2008. The national debt has crossed $34 trillion. Interest payments on that debt now exceed the entire U.S. defense budget. Currencies under that kind of pressure do not strengthen. They weaken. If the dollar loses just 40% of its remaining purchasing power over the next decade, a historically modest rate of debasement, then oil priced in those weaker dollars would need to be somewhere around $125 to $150 just to maintain the same real value as today. Add the supply crunch. Add the demand growth from the developing world. And now, you are not talking about $150 oil. You are talking about $200 oil. Maybe more. Dollar math. On screen, oil in 1971. $3.50. Barrel real value adjusted for inflation. Tilde $6.0 Today dollar losing 40% more purchasing power. Oil needs $125 to $150 to hold real value. Plus, supply deficit plus demand surge equals $200 becomes arithmetic, not speculation. Section 5. What $200 oil does to your life. 9 o'clock to 10:15 grounded, real, personal tone. Make it tangible. Let's make this real for a second. Because $200 oil is not just a number on a trading screen. It reshapes everything. Food. Modern agriculture runs on petroleum. Fertilizers, pesticides, farm equipment, fuel, transportation of goods. When oil doubles, grocery bills follow. Not immediately, but they follow. Transportation. Airlines pass fuel costs directly to ticket prices. Shipping companies pass them to every product you buy. That means every item in every store carries a hidden oil tax. Housing, heating oil, manufacturing costs for building materials, transportation of lumber, and concrete, all of it tied to energy prices. Everything made from plastic, which is essentially everything you touch in a modern life. The people who understand where energy is going and position themselves ahead of it will look back at this moment as one of the most obvious wealth-building windows in their lifetime. The people who are told EVs will fix it and oil is dying will wonder what happened. Section 6. How to position before the math plays OU. So what do you actually do with this information? I am not a financial advisor. This is not financial advice. Do your own research. But here is how I think about positioning in an environment where energy prices are structurally going higher. Number 1. Energy producers. Companies that pull oil and gas out of the ground benefit directly when prices rise. Look at integrated majors and also smaller independent producers with low production costs. Number 2. Energy royalty companies. These are businesses that collect a percentage of revenue from oil and gas production without bearing the operating costs. When prices rise, their income rises. When prices fall, their exposure is limited. Number 3. Oil ETF. If you want broad exposure without picking individual stocks, exchange-traded funds that track energy indexes give you diversified access to the sector. Number 4. Commodity currencies. Countries like Canada, Norway, and the UAE have currencies that strengthen when oil prices rise. International diversification into these currencies is a form of indirect energy exposure. Number 5. Reduce dollar-denominated risk. If the dollar debasement thesis is correct, sitting in cash long-term is a slow loss. Hard assets, oil, gold, silver, productive land historically hold real value when currencies erode. The window to position before the math becomes obvious to everyone else is always shorter than people think. The math always wins. I want to leave you with one thought. Markets can ignore math for a long time. Narratives can suppress reality for years. Media can keep telling you oil is dying, demand is collapsing, and $50 oil is just around the corner. But math is patient. The supply deficit does not care about your opinion. The geological decline rate does not watch the news. The 6.9 billion people building toward a modern standard of living are not waiting for permission. The numbers are the numbers, and when the numbers finally take over, when the gap between the story and the reality becomes too wide paper over, prices move fast. And the people who did the math early are the ones ready for it. You just did the math. Now decide what you do with it. If this video made you think differently about energy, share it with someone who needs to see these numbers. Subscribe if you want more math that the mainstream refuses to run. I will see you in the next one. Outro music. End screen with subscribe button and related video suggestions.